So what are fixed assets? What are they useful in business? So what is the significance of fixed assets in business? Fixed assets are the non-current assets in business which stay for more than a year and are used for operating to generate income in the business. Okay. So generally to categorize your assets, assets are of two types, current assets and fixed assets. So current assets are like cash, bank balance in the bank, or any bonds and liquidity negotiable instruments that company hold. So all of them are considered to be current assets. Current assets are something which you can easily sell in the market, liquidate and get the cash, or you can move it in the market or work use for the working capital of the company. Whereas it comes to fixed assets, it's not like that. Fixed assets are some no usual things or machines, equipment, or any other thing that are used in business or that would add the value to the company, and they would be used for generating the income. So not all the fixed assets are used for generating the income, but most of them are used for operating and using generate the income. So if company is having plant and machinery, so plant and machinery is used for production. If you produce the goods, then only you will have your revenue, right? Once you sell the goods. So that is why they are used for operation to generate the income of the business. So in fixed assets also we have multiple types. So before we discuss about fixed assets, multiple types. So why fixed assets are maintained separately in the business? Why do we have to maintain fixed assets separately in the business? And why do we have a separate module for fixed assets? So the thing is that there are certain rules and regulations that given provided by the authority of the Companies Act as well as Authority of Tax Act in India, and also according to different gap IDs, IFRS and local gap IDs of different countries. They have the guidelines to maintain fixed assets. Maintain fixed assets in the sense how to maintain fixed assets. So a fixed asset has to be depreciated on periodic basis according to the guidelines of these acts or gaps. So depreciation in the sense again, you will come to a point where the asset value will be reduced on periodic basis because asset is being used, right? So it will be reduced. So in order to maintain fixed assets according to the acts, or if you have to reevaluate the fixed assets, or you know write up, write downs, or increase the value of fixed asset if at all it increases in the market, or reduce it if at all it gets damaged. So in order to maintain all these things and the history of these movements of the fixed assets, either if you decrease or increase or if you depreciate, so everything has to be properly maintained. So for maintenance of all this or the maintenance of fixed assets, we have a module in Dynamics called as fixed assets module. And this is a very good module in in Dynamics actually. It doesn't really require any customizations. It is having lot of options which would be helpful for maintaining fixed assets according to any gap. And you would, it's a very logical module. It would be little tricky to understand, but once you understand the logic, yeah, it is a very easy module too. So see, in any business, there can be O2C transaction, there can be P2P transactions, or there can be sometimes only O2C or P2P transactions. If it is only a distribution company or selling company, something like that, depending on the business model. But fixed assets are a consistent module, or fixed assets are consistent in any company. If when you come to any industry, if it is a manufacturing industry, you have fixed assets in it. If it is a logistic industry, you have vehicles as fixed assets in it, which would transport our warehouses on the vehicles would be the fixed assets. And if you have any other industry like hospital industry, you have machines, lot of machinery in the hospitals, equipment, so everything will come under fixed assets. So fixed assets is a unavoidable module in any business, or it's a process that we could not avoid. So Dynamics provides diversified options to manage fixed assets to maintain fixed assets, record the details of fixed assets. So we're gonna understand how we can record the fixed assets and what are the various configurations and operations that we can do in Dynamics related to fixed assets. So fixed assets also comes up with some types. So types of fixed assets. Tangible fixed assets. So what is tangible? What is intangible? You can see and touch, which means like buildings, land, plant, machinery, vehicles, right? And what else we have? Computers, if you have in business. So everything comes under tangible fixed assets. Tangible fixed assets are that we can see and touch and we can maintain. Coming to intangible assets, they're just opposite. So intangible assets are the fixed assets which are only on the paper. So fixed assets which are only on the paper, but we could not see or touch them. So the examples of intangible fixed assets are like goodwill. Goodwill is a company's brand value, you can say, in the market, which can be maintained as a fixed asset. Or if you hold any copyrights, that could be a fixed asset. A copyrights on a particular formula or a product or any concept. So everything that you register as a copyright is a fixed asset. So other than this, you also have different types of intangible assets. Other than goodwill and copyrights, you might be having anything else which could not be, can call consider software as also fixed asset, a fixed asset, but it is an intangible fixed asset, right? If you have a software, software is not a tangible fixed. You cannot touch the software or you cannot see a software. It is existing, but it is somewhere there in the laptop or somewhere there in all the laptops. So it's an intangible fixed asset. Other than this, we also have one more type of fixed asset called as financial fixed assets. Financial assets. What are financial assets? Yeah, financial fixed assets are something like the long-term bonds, you can say long-term bonds, investments. It can be bonds or anything. Investments of the business outside. So if company is investing long-term, like for 2, 3 years, 4 years, or 5 years with a contract, so those investments also comes under financial fixed assets. They can maintain them as financial fixed assets. Some people will maintain them as fixed assets. Some people will not maintain them. I mean, they don't maintain them, but they just show it in the balance sheet as financials or their investments on the asset side. That the company, whatever they have invested in other companies or in other portfolios or somewhere or lent money to some other people outside the company. So that would be recorded under assets. So these are the different types of fixed assets that we have. Let's straight away come to the point. So this is all the theoretical part of what are fixed assets and what are the different types of fixed assets. So now we're going to configure different setups or required for the maintenance of fixed assets in Dynamics module. The first configuration that we are going to do is depreciation profiles. So depreciation profiles or the depreciation methods are used to depreciate the fixed assets on periodic basis. Depreciating fixed assets is necessary because it's according to the authority rules that you have to depreciate the fixed assets. In any country, if you go, maintaining fixed assets comes up with depreciating them on periodic basis. How periodic means it can be monthly or it can be yearly, it depends. How frequently they want or the authority want to maintain, depreciate the assets, they can depreciate the fixed assets. So before we go for the process of depreciation, so what is depreciation? Reduction in the fixed asset value on periodic basis. Why do we reduce it on periodic basis? Because we keep on using the fixed asset, right? Its value gets decreased. See, if you buy a car today at 5 lakhs, you can't sell the same car at 5 lakhs after 1 year. After you run in the car for like 1 lakh kilometers, you cannot sell the same car for same 5 lakhs again. So you might have to sell it with a lesser price, like 4 lakhs or 3 lakhs. What happened to the remaining 1.5 lakh or 1 lakh? So it's considered to be a depreciation or a loss. So depreciation is a loss in the business where whenever you use your fixed assets, you have the reduction in the value of fixed assets, which is recorded on the periodic basis. So how we have to depreciate? What kind of formulas we have to depreciate fixed assets? Can we depreciate them like anything? Or do we have a separate pattern to depreciate fixed assets? What depreciation methods do we have any? Straight line service life method, reducing balance method or diminishing balance method. And we also have different methods like consumption methods, factor methods, as well as we have percentage of reducing balance methods. And we also have manual method where we can manually depreciate. So Dynamics provides various options to maintain different depreciation methods. In India, we majorly follow, according to the Companies Act, they follow straight line method. And according to the Tax Act, they follow reducing balance or the diminishing balance method. So let's see how each of them work or what are the different types of depreciation methods or the we have in does Dynamics provides and how we can configure the depreciation profiles accordingly. Okay. So for that, we have to go to the legal entity Reliance. So in this, we are going to fixed assets module. Here it is. In the fixed asset module, firstly we'll go under setup. So majorly we have to work on setup first. In setup, we have depreciation profiles. This one, fixed assets, setup, depreciation profiles. Click on depreciation profiles. So you can also see the navigation here, fixed assets, setup, depreciation profiles. So you don't have any depreciation profiles here. You have to configure a depreciation profile. So let's see how we can configure a depreciation profile. Click on new. So I'll just give this method as straight line service life. You just can copy the name here and paste it here, straight line service life. Then I'll select the method. See, we have different methods, straight line service life method, reducing balance method, manual factor consumption, straight line life remaining, percentage of reducing balance methods. Let's see how each of them will work. I'll just give you an overview of how each of them work. Okay, I'm just selecting this method here and depreciation according to the calendar and on monthly basis. Okay, you can select either calendar or a fiscal calendar. Fiscal calendar means again you can create a separate fiscal calendar for fixed asset maintenance if you want to. Or you can use the same fiscal calendar that you are using for the company. If you want a different periods, you can create a different fiscal calendar as well that you can use. I'll show you where you can link a different fiscal calendar if required. And periodic basis, periodic frequency of depreciation. Do you want to calculate monthly depreciation, quarterly depreciation, half yearly or yearly? So most often it will be monthly or yearly. So here I'm selecting monthly. Save it. So I just created a depreciation profile. If you want to create one more, you can create one more like the reducing balance method. Somebody is saying, right? So I'll just create it as reducing 30% method or 20% method. Okay. Reducing balance 20%, I would say. Here I have the best method, reducing balance. But for this method, I'll get a separate option called as percentage. Here, how much percentage I need? 20%, right? So I'll give 20%. Okay, depreciation year, calendar year only I'll follow. Periodic frequencies yearly. Calendar year means it's from January to December. If you want to, if you company is following something like from, you know, March to April like that, you can follow your fiscal calendar and you can go with your frequency like monthly, up to you. So April to March, if you're the company is following, you can just select fiscal calendar. Here, normal calendar in the sense it's assuming from January to December. Full depreciation, yes, if you want to fully depreciate the fixed asset by the end, you can depreciate it fully. So here, select the option to fully depreciate the fixed asset when service life that remains is zero. I'll come to this point, how it work. So this is how we can create depreciation profiles, but how each of these depreciation methods work and how they depreciate a fixed assets, we can see in this document. Depreciation methods, Dynamics 365. Here we go. Depreciation methods and conventions. Let's talk about the conventions later, but these are the depreciation methods we have. Straight line, straight line service life method, reducing balance method, manual and everything. If you click on this, or you can right click on this and open link in new tab, you will see what is straight line service life depreciation is and how it will work. So here you will have the formula of how it is calculated, straight line service life. This is up. So we'll just, and generally let's see this example actually. We will see it here itself actually. See, the asset is bought for 11,000 or the fixed asset is acquisition value is 11,000. So I can see the salvage value of the fixed asset is 1,000. Salvage value or the scrap value. In the sense, we will leave this 1,000 from depreciation and we will reduce the depreciation only from the base amount of the fixed asset. So acquisition cost minus salvage value is the depreciation base, 10,000. Acquisition cost is the rate at which you bought the fixed asset. Salvage value is what you have decided to remain in the fixed asset. You don't depreciate the salvage value generally, but you will depreciate the remaining value, which is called as depreciation base, 11,000 minus 1,000. Service life of the fixed asset is assumed to be 5 years. The asset will serve for 5 years, or according to the Companies Act guidelines. So the asset service life is 5 years, let's say. So if at all it is for 5 years, the yearly depreciation will be 2,000. Right, 10,000 divided by 5. Straight line method. Every year you will have straightly 2,000, 2,000, 2,000. For 5 years you will have 2,000. At the end, complete 10,000 will be completed at the end of 5 years. And what will remain is the scrap value will remain. Anyway, scrap value is decided not to be depreciated, right? So at the end of 5 years, only that 1,000 will remain. See here in the first year you have 2,000 depreciation, which will make the asset value to 9,000. 9,000 in the sense 11,000 minus 2,000 depreciation, 9,000 net book value will remain. Second year also you have 2,000 depreciation. I mean every time it is same 10,000 divided by 5, 10,000 divided by 5, and same formula every for all the 5 years. Same 2,000 value until and unless you make some acquisition adjustments or increase the asset value or write up the asset value. Otherwise, the formula would be all the same for entire 5 years. So you can see clearly that how it is being depreciated. Every method is having its own equation. So this is straight line service life method. It's a very simple method. Every year you have a same amount of depreciation. The equation is depreciation base divided by service life. That's all. Depreciation base divided by service life of the asset. 10,000 divided by 5. 2,000, 2,000, 2,000, 2,000, 2,000. Same equation. And every year you have the same depreciation, as well as it will be reduced from the net book value of the fixed asset every year, and at the end you will arrive at $1,000 remaining on your fixed asset after all depreciating all the 10,000. So here you have another example where you also have acquisition adjustment. So let's see, in the first year the asset is acquired for same 11,000, okay, and the salvage value is 1,000. Depreciation base is 10,000. So in the first year depreciation is calculated as 10,000 divided by 5, means total 2,000. Right, 10,000 divided by 5 is you have 2,000 depreciation for the first year. After reducing depreciation from the asset value, the net book value of the asset is 9,000 at the end of the first year. After reducing 2,000 from the original asset value of 11,000, here you can see you will have the net book value of 9,000. After 1 year, what they did is they have an acquisition adjustment. Acquisition adjustment in the sense addition of value to the fixed asset, or they have added some other valuable thing to the fixed asset. Let's say suppose I got a car. Okay, I have After 1 year, I have added bumpers and safety rods and everything to the car. So that's an value addition to the car. I have expended another 50,000 for that value addition. So I will add it onto the fixed asset, onto the car fixed asset. The accessories I have added to the car, I will add that particular cost price of the accessories to the fixed asset value, or I'll capitalize that cost price. So that 4,000 is the acquisition adjustment. They're adding to the existing net book value of the fixed asset. Existing net book value of the fixed asset at the end of first year is 9,000. So 9,000 plus another 4,000 is the acquisition adjustment. They have the net book value of the fixed asset then 13,000. 13,000 you can say 9,000 plus 4 is it is 13,000. Yes, right. And you see how depreciation is being calculated. Depreciation will be calculated on 14,000 divided by 5. How 14,000? The original depreciation base amount of 10,000 plus the acquisition adjustment of 4,000 is considered for depreciating. So earlier it used to be 10,000 divided by 5, 10,000 divided by 5, right? So here in between you have some adjustment or addition. So now you have 10 plus 4, 14,000 divided by 5, 2,800, 2,800, 2,800 and so on for next 4 years. And again that would end up at this 1,000 only. In the year 6 there is another 800 remaining accordingly. So that 800 will be adjusted anyway. So remaining amount minus salvage value will be taken. The 1,000 will remain at the end. But the other depreciation will also be depreciated accordingly. Other remaining value of the asset except the 1,000 will be depreciated. But this is the equation in case if you have any adjustments in between. So you can better go through this document to see how it is working. And I'll demonstrate you another two examples of fixed depreciations which are very important. So this is straight line service life method. I hope this is clear for you. There is another method here called as straight line life remaining method. So this is also one of the method that is prominently used in the market also in India, straight line life remaining. So straight line life remaining is more or less like straight line service life only, but it's a different equation. See here, asset is acquired for same 11,000, salvage value is 1,000, depreciation base is 10,000. As acquisition cost minus salvage value is the depreciation base. We all know that. Service life of the asset is 5 years. So yearly depreciation is 2,000. We all know this one. Now let's see the equation slightly change or the formula to calculate depreciation slightly change. The formula is acquisition cost minus salvage value divided by service life. Means 11,000 minus 1,000, 10,000 divided by 5 in the first year. In the first year, as you can see here, 11,000 minus 1,000. So depreciation base amount 10,000 divided by 5. 2,000 is the depreciation calculated. Net book value of the asset is 9,000. When you come to next year, second year, see here clearly. Here you have net book value minus 1,000 again. 9,000 minus 1,000 divided by 4. 4 means you only have 4 years of service life, right? By in that year, second year, you only have 4 years. So the numerator will decrease as well as the denominator also will decrease. This numerator as well as the denominator, both of them will decrease. So this is the equation for the second year. 9,000 net book value minus salvage value divided by 4. 2,000 again. Again, you have the same equation. Net book value minus salvage value divided by 3. 2,000. The same again, the same again. So this is straight line life remaining method. Life remaining in the sense whatever is the life remaining in the fixed asset, that is considered to be the denominator of the fixed asset. So this equation slightly differs compared to straight line service life method. But the calculation you see 2,000 only here also, 2,000 only here also. But it would little vary when you have an acquisition adjustment in this particular process. If you have acquisition adjustment here, you have a separate equation, right? But if you have acquisition adjustment here, you will have different equation. The valuation of depreciation would slightly differ in case if you have any such kind of adjustments in between. So that's the difference between these two methods, straight line service life method and straight line life remaining method. Just go through the documentation of, you will get a better idea about what is what. Then let us discuss about reducing method, reduce balance depreciation method. It's here. So on reducing balance, I'll just explain the example here itself. So reducing balance, let's say reducing 20%, right? I said, so reducing balance 20%. If at all we take this one, let's say asset value is 11,000 according to their example. Acquisition value is 11,000. Then salvage value is 1,000. Okay, which means depreciation base amount is equal to asset value minus salvage value, which is 10,000. So on the 10,000, every year we have 20% reducing balance on the net book value of the fixed asset. So the first year, how much depreciation we'll have is 10,000 into 20%. So how much it is? 2,000 will be the depreciation for the first year. So once you reduce 2,000, what is the net book value for the first year? For at the end of the first year, it is 9,000, or you will have 8,000, right? Depreciation base is 8,000 only. It means salvage value, you'll keep it aside, but net book value is 9,000 according to you. But in the next year, when you are going to depreciate, second year, so you take the depreciation base as 8,000 only. You will take that 1,000 off from the 9,000 again. So 8,000 into again 20%. What is it? 20% on 8,000, 1,600. So you'll have 1,600 for the depreciation. Again, what is your net book value here? 9,000 minus 1,600, something like 7,200, right? 9,000 minus 1,600. 20% on 8,000, okay, it's 1,600 only. Then we have third year. So in the third year, you will again have the same formula. 7,400 minus that salvage value 1,000, which is 6,400 into 20% again. So which is equal to something, you'll get 640 into 640. 1280. That's how the depreciation is calculated in the reducing balance method. Every year on the net book value, 20% will be reduced. So if the service life is for 5 years, so for every year you have 20% until the 5 years. So at the end, if there is something remaining, so what has to be done with that will be, I'll show you. Suppose if it is only for 3 years, service life of the asset is 3 years. Okay. Service life is, let's say 3 years. So after 3 years, what is the net book value? 7,400 minus 1280. Let's go with the calculator quickly. It's not so quick. 7,400 minus 1280, 6,120. So 6,120 is the net book value of the fixed asset after 3 years. So the service life of the asset is 3 years only. So we are arrived at this particular amount. So what has to be done with this amount that is remaining? So if you want to fully depreciate it, you have this formula right here, full depreciation. This is what happens. Select this option to fully depreciate the fixed asset when service life remains 0. If you click on it, it will fully depreciate it. That's how it is. If you don't want to fully depreciate it, you will leave as it is and the net book value will remain at 6,120. Further, if you want to depreciate, you can, or if you want to sell it off, you can. Up to you in the business. So that's how it works. Then let us discuss about another one or two of them, very easy ones. So these are 125% reducing balance, 150% reducing balance, 175 and 200. First, let us discuss this 200% reducing balance. All of them will be in the same pattern. It's a pretty simple example. Here you see asset cost is 11,000, salvage value is 1,000, depreciation base is 10,000, service life is 5 years. Okay, this is clear, right, for all of you until here, service life. So under 200% reducing balance, every year percentage will be decided by this 200% divided by the service life of the fixed asset. Means service life of the fixed asset is 5 years. and the you have taken complete depreciation as 200%, like 200 divided by 5 will be the depreciation per year. So every year you will have 40% depreciation on the fixed asset value, where you can see in the first year 10,000 into 40%, 4,000 is the depreciation. In the second year 6,000 into 40%, 2,400 is the depreciation. Third year 3,600 into 40%, 1,140 is the depreciation. In the same, like in the fourth year you will again have 40%, fifth year also again you have 40%. Whatever is the net book value of the asset minus the scrap value into 40% will be the equation. So every year you will have 40% depreciation. If at all you have service life as 5 years, if at all you have service life as 10 years, it is 200 divided by 10. Every year you have 20% depreciation. So what depends on the percentage amount on the service life. Okay, you also have another method called as 150 reducing balance. Let's say all are same. So it is 150 divided by service life. 150 divided by 5 means 30% you will have. So every year you have 30% depreciation. See, you have 10,000 into 30%, 3,000. After deducting that 3,000, you will have 7,000, right? 7,000 into 30%, 2,100. And after reducing that one, you have 4,900. On that 30%, 1,470. Again, after deducting the 1,470 from 4,900, you will have fourth year depreciation into 30%. So that's how it is calculated. The total amount of depreciation percentage divided by the service life, you will have that much of amount every year. Suppose if you are selecting 150% reducing balance depreciation method, then you have service life as 10 years, let's say. Every month you have how much percentage, guys? Every month you have, if the service life is 10 years, it's 150 and the service life is 10, let's say. So 150 divided by 10. Every year you will have 15% depreciation. Here, since you have 5 years of service life, you have 150 divided by 5, 30% depreciation. Okay, so every year you will have 30% depreciation here. So how we can decide that? We can decide here. You can create a depreciation method here. Let's say 200% reducing I created. Okay, you can just select it here, 200% reducing balance, as you can see here. Okay, and calendar and monthly. So it will calculate on monthly basis again. So how it will calculate on monthly basis? Until now we are only seeing the yearly equations, right? So suppose in the first year you have 2000, right? So 2000 divided by 12 will be the depreciation for every month. So 2000 is the depreciation for the complete year, that is calculated. Divided by 12 is on the monthly basis depreciation will be calculated. Suppose if this asset is acquired only in so and so date, for that particular date, from that particular date, the adjustment will be done automatically. There will be a slight reduction. Suppose if the asset is acquired in the month of July 1st, you only have 6 months for the fixed asset, right? Life, half year only. So for half year only, depreciation will be reduced for that fixed asset. It all again depends on how you want to calculate the depreciation for the first year or the first period, either for the first month or the first year or the first quarter. It all depends again. We have separate equation for that called as depreciation conventions, which we are going to cover. So just go through this depreciation methods page. So each one is having a hyperlink. If you click on it, it will open another window. Consumption method, which is for the consumable goods or where there is some perishability or consumption factor involved. So unit depreciation. If there is, if it is a food processing company and they have their raw material stored in the godown, suppose if they are consuming it on daily basis, so they can depreciate it on monthly basis, the loss that they incur on this consumption. So that is also there, that can also be recorded using the consumption method. Just go through the example. Okay, so this is how we can create the depreciation methods. I'll create one more 150% reducing balance method. 150% reducing balance. Okay, here I'll select the method here as 150% reducing balance, calendar and yearly. If you want to fully depreciate at the end of the year, you can enable this option. If you want if you want the asset value to remain as it is after completely depreciating, so you can leave it as so. So after 5 years, there won't be any depreciation calculated further if the service life of the asset is 5 years. If the service life of the asset is 3 years, after 3 years, there won't be any other depreciation calculated if you do not enable this parameter. But if you enable this, further also depreciation will be calculated, or in the last date itself, the entire amount of asset will be depreciated. I mean, excluding the scrap value. That's how this works. So this is the way we can create depreciation methods. So recently there are also some new introduction of depreciation methods. So accordingly, according to the requirement of the client, yes, Dynamics provides all the depreciation methods that are necessary. So there are also some factor or conditional depreciation method. So we can go through this one and you will understand better about how each depreciation method functions.